On this episode of Divorce Court, are the stock market and the Federal Reserve working things out and getting back together? Speaking of the Federal Reserve, they raised rates yesterday 75 basis points as expected in the face of one of the weirdest economies on record. Bitcoin looks like it's starting to define itself as a techiest part of the tech sector. And the housing market, hard edge continues to come off mortgage interest rates, and it looks like we're having a little bit of a shift towards a buyer's market now. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. Hope you're having a great week. All right, well, the stock market looks like it thinks that it's getting back together with the Federal Reserve. Stock market recently bottomed on June 16th. Nice recovery off that bottom, about 10% or so on the S&P 500. Two things about this. A, could this be a dead cat bounce? Because as we know, some of the biggest rallies on Wall Street have happened during bear markets. Or B, have we indeed found a solid footing for the markets to build a base off of and move higher from here? We will see. One thing is for sure, the stock market economy and the real economy are completely disconnected. Let's use yesterday as a perfect example. The Federal Reserve raised interest rates 75 basis points as expected yesterday. And on that same day, we've gotten our third consecutive down month of consumer confidence reading number. Well, that would maybe make one think that the stock market would sell off, and it did the absolute opposite, and it rallied really hard. Right now it's Thursday, markets are still open as I'm doing my show here, and the markets are up again. So what the stock market wants is the Federal Reserve to play nice. The stock market really doesn't care about the economy. Stock market cares about money supply and money flow and the old TINA trade. There is no alternative. And it looks like people are jumping back into stocks, but we will see how long this lasts. But we can surely say now the stock market, economy, and the real economy at this point pretty much have nothing to do with each other. Just look at the last 2 days. And the Federal Reserve looks like they are giving the stock market a light at the end of the tunnel. During the press conference yesterday, after they had their meeting and raised 75 basis points, the chairman basically came out a little bit more dovish, said they would be data dependent, and they might be towards the end of this extreme rate hike cycle that we're in. Yeah, but we'll see what they do. Now, speaking of the Federal Reserve, I want to congratulate them. Technically speaking, as of this morning, they have put us into a recession, 2 consecutive quarters of contracting growth. Question I've been asking, A, how deep is the recession? And B, can we really be in a recession if everyone's all of a sudden an expert on what a recession is? Time will tell, but the Federal Reserve is certainly dealing with a very weird economy. One example, I keep seeing headlines, and I mentioned this a few weeks ago, job layoffs all over the place, but then there's job openings all over the place, and it's a bit of an extreme thing. I think this will settle in as the year closes itself out, maybe at the end of the third and fourth quarters. But right now, this is a very weird thing. A lot of job layoffs and a lot of job openings. Federal Reserve is dealing with a weird economy. Another thing about the Federal Reserve, they're always looking at data to make their decisions. Data is always lagging. Data is in the past. I think what we're going to have to play off of on a move forward basis, confidence and sentiment, as I keep discussing. That's basically everything in life at this point. And I think confidence and sentiment are going to rule the day every day moving forward until the economy normalizes itself. Speaking of the economy normalizing itself, quick note here on the Treasury yields. Still inverted, deeply inverted. The short-term maturities are higher than the long-term maturities. As we know, this is not a good sign. This is a sign of people not knowing what's going on and uncertainty, and a sign of a recession to come, or technically speaking, the recession that we're in. Here's the thing about the Federal Reserve now. It sounds like they're going to back off, but we're back to this guessing game now. If they're going to go 25, 50, or maybe 75 basis points, they're going to be data dependent, but I think they're going to make their decisions more in real time because they also know the data lags. But here's the deal with the stock market and the Federal Reserve. Bad news for the economy. Once again, good news for stocks. And it looks like after yesterday's Federal Reserve meeting, there's some confidence back in the Federal Reserve's ability to navigate and operate the economy and maybe get us a soft landing, as some people like to speak. I think they're doing an okay job. I think they've caught up with raising rates. And believe it or not, soon enough, we're going to talk about the Federal Reserve starting to cut rates. We'll get there, though. Moving on to Bitcoin, I think it's finding its definition as the techiest part of the technology sector. Here's the thing about Bitcoin. That June 16th bottom I was talking about the stock market, nothing has rallied harder than Bitcoin. I want to say it's about 25 to 30% off of those lows. And that is an extreme version, an extreme mirror of the NASDAQ, which is the tech-heavy index. And it looks like Bitcoin is the techiest of the tech right now. And it's led this rally up, and it looks pretty healthy right now. Here's the thing about Bitcoin. It's agnostic. It has no religion. It trades 24/7, 365. It doesn't have holidays. It has nothing. So if on Saturday night you're going to wonder, if you're wondering how the stock market's going to open up on Monday morning, you can basically, because futures aren't open then, you can basically go look at Bitcoin and all other crypto. Whatever they're doing is how the futures are going to go open up Sunday at around 6 p.m. East Coast time, 3 p.m. here on the West Coast. So this Bitcoin, I think it's coming. To fruition here, finding its definition. A couple other things about Bitcoin. I do know that the best engineers in the world coming out of school now are all going into crypto. They used to go onto Wall Street to set up the algorithmic trading and the bots, and now they're doing their thing in crypto. So those people are very smart, the smartest people in the world, those engineers coming out of those schools, and they're going into crypto. And here's the other thing. This is a little bit doom and gloom here. Last week I talked about my troubles with the actual environment, water, bees, trees, flowers, all that kind of stuff, outside. If the environment gets bad enough, we're all going to have to actually live in the metaverse because you can't go outside because it's 130 degrees, as I mentioned last week. And Bitcoin at that point and all crypto will be the currency of use in the metaverse because you can't use dollars in the metaverse or currency or dollars you can fold and put in your pocketbook. So Bitcoin, I think, is going to have a lot of uses in the future, not only as a natural hedge against inflation, but as actual means to operate in the metaverse, which if the environment outside gets bad enough, we're all going to have to sit inside and live on our headsets to communicate with people. Moving on to the real estate market, I find it to be actually a healthier market than anticipated. As I mentioned, the hard edge has certainly come off of mortgage rates here in the last month, and looks like we are, in some cases, headed towards a buyer's market indeed. And the reason I say that is because the buyers, from what I've heard from a lot of my very smart agents, there's not a lot of sense of urgency to make the offer or to up the offer or to counter the offer in 2 seconds like there has been. So my depiction of this is we're probably in a 65-35 split. 65% of the market being a seller's market, 35% of the market being a buyer's market, and that's a much healthier balance than it's been, where it's been 100% a seller's market up until the last few months. And as always, my favorite part about real estate, the mortgage market, honest to goodness, healthy as can be. Money's there. Banks want to lend it. Consumers do want to consume this money at softer interest rates, which is indeed what has happened in the last month. Okay, everybody, that is my show for this week. I hope you enjoyed it. As always, if you have any mortgage-related questions, please don't hesitate to reach out to me. Thank you for watching the show. I hope you have a great rest of the week, headed into the weekend.